Hi, this is R Sundar. Welcome to question answer session 3. First question, Mr. Arun Kumar Jain. I had invested a substantial part of my retirement funds in mutual funds in 2017. Now my corpus is down by about 35%. I felt I should exit mutual fund completely and transfer the funds to debt funds. Your advice. I feel very bad for this guy. And retirement fund, he put all the money at one go and the market is down because of coronavirus and he has lost nearly 35%. But always remember a rule, whatever is your age and that percentage of money must go into debt, only the remaining money should go into equity. Say for example, if your age is 25% of the money you must keep in debt, remaining 75% of your money you should bring it to equity. So I'm sure he has retired means his age must be around 60. So if your age is 60% of your money should be kept in debt. Only the remaining 40% must be brought to equity. So this is one rule you should remember, you should follow. Always there must be some money in debt. Not entire money should be brought to equity. So that's number one. Number two rule is that when you retire, you did not have the habit of investing in stock market. But when you retire, you are getting a huge sum of money and that entire money you bring it to the stock market at one go. So that is also not good. So that is why most of the experts will advise you keep investing at different intervals or systematic investment plan. If I would have been in his place or if he had asked me for the advice, what I would have told him, keep all the money in debt mutual funds and every year you will be getting some interest. Whatever interest you are getting it, so you assume that you did not get the interest and that interest component you put it in equity. So that even if the equity falls, you will not worry much because the shares were bought out of the interest income, not from the hard earned money. So please remember the golden rules. Keep always a percentage of money in debt as per your age and don't put all the money in one go. Always use systematic investment plan. And if the markets are good, you also do the systematic withdrawal plan. Otherwise, market may go up and it may come down anytime. So systematically, you have to withdraw some money and should move it to debt funds. Next question, Mr. Manjunath Bisani. Please share your favorite strategy you use in your trading and do suggest whom do you admire the most in the trading community. So two questions. What is my favorite strategy? We have to change the strategy as per the market conditions. But generally, my favorite strategy is short straddle. And so that is what I like to do. And many times if you see my short straddle trades, I post it in Twitter. And last time I conducted a webinar for charity. So there also I did share the most popular strategy. Whom do you admire most in the trading community? Honestly, I tell you, if I want to admire, I just go to my bedroom and see the mirror. So the person in the mirror is the person I admire the most. Otherwise, I am not a big fan of any other trader. Where can a beginner enroll for course you are conducting? Any course for beginner, I like to join. I am 19-year-old and I like to option trading. I'm sorry, right now we do not have any courses for the beginners, but very soon we are planning to start teaching the basics also, but it may take some time. So until then wait, and if you cannot wait, you may look for some other people's courses. Next question, what will happen if I bought and hold in the money option on expiry due to non-availability of buyers? Will I get the difference of spots and strike price in my account after STT or is there any penalty for that? Number one, earlier there used to be some penalty if you do not square up the position yourself when it comes to in the money options. Now there is no more penalty. So there is no higher STT. Earlier also it was not penalty, it was a higher STT, 10 times higher than the normal STT. But now there is no such thing, absolutely. You will get the intrinsic value. But this applies only to indices, not for stocks. In the money options in stocks, if you do not square up, then that will result into physical delivery. So you better be careful. And I repeat once again, if you are a trader, you better trade only indices. You do not trade in stocks. Mr. Sudeep Singh, can you please suggest a formula to calculate premium? Easy one, which can give approximate value instead of complex formula of binomial pricing model or Black-Scholes formula. Very simple. Why do we look at binomial and Black-Scholes formula? Okay, I'm a mathematics teacher. Even when I look at binomial formula or Black-Scholes formula, I feel like sleeping. They are so complicated. So there is a very, very simple way to know what is the fair value of the option price. Just look at the trading terminal. At what price is trading, that is the fair value. And believe me, and whatever the prices at which the options are trading, so that will exactly reflect the all the whatever model you call it as binomial model or Black-Scholes formula. So that price will be exactly reflecting that. So that is the fair value. Mr. Shah, hello. How physical settlement in Nifty happens if we let the option expire in the money and do not square up? Do we get or give all shares in the same proportion of Nifty? It is not true. The physical delivery is only for stocks, not for indices. All the indices are cash settled. So there is no physical delivery of Nifty or Nifty components when it comes to indices. Tirumurthy, sir, I am an office goer. What will be the best strategies for better return on investment with minimum monitoring, as there will be a new margin system in our market from June 2020. So if you are going to office, if you cannot monitor the changing prices every now and then, so the best strategy is to play in long-term options. In US market, they call it as leaps. And be proud to trade in long-term options, and because even Warren Buffett plays only in long-term options. Breaking Bad, is it mandatory to close the position on expiry day? For example, I sell Nifty option for ₹10 and it is 0.05 on expiry. What happens if I don't close the trade? Also, please answer the same for stock options case. Thank you. All the out of the money options, you don't have to square up. You can just leave it. If you don't mind, you can square it up at 5 paisa. Let me tell you unusual problem I had faced. When you need to submit the accounts of statement to the income tax department, so at the end of 1 year, if you are selling and then you are buying, when the broker gives the statement, he doesn't show the selling first, buying later. He shows buying first, selling later. So let us say I sold 10 call options and I did not square it up. So at the end of the year, the financial statement, the buy will show 0, sell will show 10. But you and me know about the stock market. But the income tax people do not know. When they look at it, once one income tax officer asked me, sir, how can you buy 0 and sell 10? You can buy 10, sell 8 also. We can accept it. Because you can buy 10 biscuit packet and 2 biscuit packet is broken. So you could not sell it. So you sold only 8. Or you buy 10 televisions. You sell only 8 televisions because 2 televisions broken. So that is acceptable, sir. But here you did not buy anything. But how can you sell? I had hard time to explain to them. So Whenever you sell at 10 rupees, 20 rupees, if you square it up at 5 paisa, then at the end of the financial year, your statement will come very nicely like bought 10, sold 10. That's one thing. And second thing, you are selling at 10 rupees, by squaring it up at 5 paisa, at least you are returning that 5 paisa to the buyer. And third thing, when you are selling at 10 rupees, 20 rupees, when you buy at 5 paisa, your broker also gets double brokerage. And after all, broking industry is a very, very tough industry, and most of the brokers are not making good profit. So I try to help them to generate some brokerage. So due to all these reasons, I prefer to square it up, but otherwise there is no problem if you do not square up. You can leave it. All the in the money options only you have to square up. Even in the money options also you don't square up, nothing wrong. You will get back your money if it is indices. All the out of the money options, whether it is of indices or stocks, no need to square off, you can just leave it. But in the money, you have to square it up if it is a stock option. Otherwise, that will result into physical delivery. Prashant Chetri, how much money could you make by your option strategies if you had a capital of 1 to 2 lakhs? You can choose the time frame yourself. I am interested to know the potential of options trading. Generally, I will not advise people with smaller capital like 1 lakh to 2 lakh to come and trade in options. Options is actually for people with a decent capital. But however, from June 1 onwards, and they are reducing the margin money for the hedged positions. So you want to play the hedged position in a small quantity, you can still do it. And if your money is too small, it's always better to take position in long-term options. But again, how much return you will get, stock market returns are subject to market fluctuations. Nobody can tell you exactly how much you will get it. There is a possibility of loss also. So you must understand that. Shashank Singh, why India does not have hedge funds like Bridgewater Associations and Renaissance Tech, etc. You go to US, every Tom, Dick and Harry will be having a hedge fund. The hedge funds are very, very popular abroad. It's a very standard industry. But in India, you will find hardly any hedge funds. So that is because the regulatory issues are there, and the taxation point of view, it doesn't make a good sense to float a hedge fund in India. And there is something called tax pass-through, which is not available for the hedge fund. So in India, we don't call it as hedge fund, we call it as alternate investment fund category 3. So alternate investment fund category 1, 2 and 3, the hedge fund comes under alternate investment fund category 3. The tax pass-through is available for alternate investment fund category 1, category 2, but it is not available for category 3. So due to some of these regulatory issues, the hedge funds are not popular in India. How to handle gap up or gap down in option selling, that too when the expiry day is tomorrow? Kindly answer this query in your video. See, the gap up and gap down are bound to happen, and you are bound to be in trouble. If there is no problem and always you are going to make money, then everybody will be in this business. So every business has got certain risk, and option selling also got this risk. And gap up, gap down, you cannot avoid. The only way you can minimize the damage is to hedge your positions. That is the only way you can reduce the risk. Then he has asked, especially for tomorrow, a professional option sellers do not sell options expiring tomorrow. Usually, I advise people to sell for month only, so that big gap up, gap down also, there will be enough cushion. So do not enter into options trading which are expiring in few days time. I hope I've answered this question. Thank you for watching.